What happens when a sanctioned country defaults on its debt? That is a big question for holders of Russian debt. Leslie Picker joins us now with a look at the exposure there and what it means for the bonds. Leslie.
Yeah, David, we're really in unprecedented territory here. The market is indicating a high likelihood of default. Credit default swaps, which compensate investors if Russia is unable to service its debt, are surging this morning, up about 34% earlier. Yeah, you can see there, 34% higher. Russia has more than $100 million worth of interest payments due next week, but it's unclear that Putin will be willing and especially able to pay given the wartime financial sanctions on the country. Bond funds with Russia exposure are seeing outflows and performance marked down as a result of the recent sell-off in bond prices. The U.S. domiciled emerging market funds with the highest percentage in Russian debt include Voya, PIMCO, and Capital Group's American funds, according to Morningstar. The massive sell-off in Russian bond prices as ratings agencies cut them deep into junk territory has already caused a performance hit for many of these funds. PIMCO's income fund, for example, had been outperforming its benchmark, and thanks in part to its Russian exposure, now is underperforming, down about 5% this year. But the exposure is still relatively small compared with the overall assets these firms manage. Russia only has about $40 billion in euro and dollar denominated debt, plus any other derivative exposure that these funds might have. However, a default could mean no recourse for bondholders to get their money back. I just got off the phone with Jane Newman, a hedge fund manager who specializes in sovereign debt, and he said that the Russian bond contracts have unusually minimal creditor protections, and a traditional restructuring has never been done with a sanctioned country of this size, guys.